Hello, and thank you for joining. My name is Martin A. Smith. I am the president at WealthCare Financial Group. WealthCare is a wealth management, retirement planning, and investment advisory firm. We're located in Peachtree City, Georgia. We're also located in Washington, D.C., as well as in Maryland. Today, we are going to continue with our webinar series entitled Your Pathway to Retirement. And today's topic is investment basics, a guide to your investment options. Now, investing for some people is easier because perhaps they've grown up discussing investments around the kitchen table, and it was sort of a legacy of their family to either own stocks and bonds or work in corporations and or receive stock options in their as a part of their benefits package. And so for some families, it's just sort of a common thing to have investments, to have stocks, bonds, mutual funds, and to have that conversation flowing around in your home or in your community. In other families and communities, investing is not as common. It's not something that families have talked about. In my family, we didn't discuss stocks in the stock market in Wall Street. And so we did much later when I was like 20 years old, but it just really wasn't a part of our conversation. So financial illiteracy was a challenge, especially with respect to demystifying all that Wall Street is and understanding how the relationship between Capitol Hill and legislation and Wall Street, high finance, are really two opposite sides of the same coin. So what we're going to do in this presentation is discuss investment basics. Now, there are some aspects of this that actually is not really basic. So the title can be a little misleading, but hold tight and let's get started. So investment fundamentals. What is investing? There is speculating, which I call gambling. Speculating doesn't necessarily mean that you are taking an uneducated risk. It doesn't mean that you haven't done your homework. Gambling is also playing poker, and I don't play poker. I tried it, wasn't that good at it. But some people are really students of the game of poker, and so their odds of winning is better. Whereas other people like myself who don't play poker will probably lose a lot of money at the poker table. So I'm probably not the guy you want sitting, well, I am the guy you want sitting next to you because you'll win all my money. But it certainly isn't my skill set. Speculating isn't necessarily rooted in ignorance, but sometimes it is for those who really haven't done the work to understand what they're investing in. Then there's savings. Okay, so it's the easier route to go. Just save a portion of your income and, spend less than you make. So there's saving, there's speculating, and then both can be a approach to investing. Speculating, investing, a carefully planned and prepared approach to managing and accumulating money. A lot of the wealth in Texas has been developed by speculators. People who've gone out, these call them wildcatters. They go out and they'll search for oil, and they're speculating. And they may do some tests, drill some test holes in the ground. And they may find oil, they may not. They're taking a risk. They're investing their money in some test holes to see if they strike oil. They do, then they're doing good. Speculating isn't for everyone. So the investment fundamentals, in fact, the effect of inflation. If you think about the purchasing power of $200,000 at 3% annual inflation, and over a period of, let's get my little highlighter out here, over a period of 40 years, $200,000 purchasing power has declined over the period of 40 years because of inflation. So a 3% annual inflation can really make $200,000 today the equivalent of $50,000 40 years from now. We've seen that in housing prices. In California, where I grew up, I moved away from California to attend Howard University in 1988, and our home price was $85,000. Today it's $1.1 million, same house. So we've seen that effect, and it can work in reverse. It can work for you or against you, depending on what side of the dollar you're actually on. So this shows you about year 20, you're looking at about $108,000 spending power of $200,000. And again, as I mentioned, by year 40, 59,142. So the investment fundamentals, the effect of compounding, the growth of an annual $5,000 investment, $5,000 invested annually at the end of each year with a 6% annual growth rate, we can see that $5,000 grows to about $400,000 if you invest it once a year at the end of each year and earn a 6% return. So we're really talking about beating that inflation monster. You actually end up, I guess, with about $395 around year 29. So one of the rules that I taught to new investors when I first started my career in the financial planning industry back in 1993 in Washington, D.C., was the rule of 72. And this is a rule that I didn't understand, didn't know about growing up. I heard about it in my 20s. If you take the number 72 and divide it by the rate of interest that you receive, the answer equals the number of years it takes for your money to double. So if you're receiving a 6% annual growth rate, your money would double every 12 years. 72 divided by 6 is 12. If you're receiving a 2% return on your money, it doubles every 36 years. So think about this. And I'm going to segue for a minute, but if you look at Social Security, there is a cost of living adjustment to Social Security, where back when Social Security first started, the adjustment was 8%. It was actually as high at one point as 11%. The cost of living adjustment, meaning the amount of income that you could receive on your contributions to Social Security over a number of years that you've worked. Today, so at 8%, if you just want to understand how that affects Rule 72, that doubles every 9 years. But today, the cost of living adjustment on Social Security is about 2.8%. So you're talking about 25 years. And the question is it keeping up with inflation? Okay, let's move on here. So the sooner you begin, the better. Do not put off investing. The sooner you start, the longer your investments have to grow. Playing catch up later can be difficult and, yes, very expensive. Again, we're looking at $3,000 annual investment at 6% annual growth rate. Assuming you reinvest all earnings and no tax, so we're talking about a tax-deferred account, starting here, 20 years out, roughly almost $700,000. You start at 35, you're going to hit about maybe 180, 190. You start at 45, you're just about maybe at about 150 by age 65. So age 20 you begin, age 65 you stop. You're going to have substantially more money on $3,000 annual investment at a 6% annual growth rate. So the sooner you begin, the less expensive it is, and your funds will have longer time to compound. And these are the actual numbers at 65. Let me go back there. Okay. So, identifying goals and time horizons, investment goals, retirement. That's a big goal, and that's what we're talking about here. And that affects everyone. One of the things we focus on in our company, in WealthCare Financial Group, we are a retirement planning and investment advisory firm. Our tagline is Together for Your Retirement. And we work with a lot of retirees. We help people prepare for a secure retirement. That's the focus of our business. Education is another investment goal. I have 7 children. My wife and I have been married 25 and a half years. She's given birth to all 7 of our children, 6 girls and a son. So guess what? I have a lot of education expenses. Special purchases. I love lake homes. I grew up going to a lake house in Lucerne, California, at a big, beautiful lake called Clear Lake. My grandmother purchased, I think, back in the 50s or 60s. And it was just sort of a tradition in our family. And so I'm buying my own lake house one day. And so you want to think about the special purchases that you may have in mind and how your savings and investing goals lines up with making that or bringing that goal to fruition. Short-term goals and long-term goals. Lake house for me is a short-term goal. Long-term goal is retirement. In general, the longer your investment horizon, the more risk you can afford to take. Really, really important. If you're going to start investing when you're younger, you can weather the storm of volatility in the market. You can weather the storm of a recession. You can even weather the storm of a great recession because you have that much time to recover. If you are starting late, and let's say you have 10 years to retirement, you cannot be as aggressive. And you probably can maybe bounce back from one recession, but definitely probably not two, considering how many years it takes to break even. If you have $100,000 and lost 50% in the market, you've got to get 100% return just to get back to break even. And it is not typical to go from $50,000 to $100,000 in a year, but it is more probable to go from $100,000 to $50,000 in a year. If you have to go from $50,000 to $100,000, you're talking about you're probably speculating, gambling with your money. You're probably concentrating in one or two stocks, in hopes of it appreciating greatly in a short amount of time. And that is a enormous amount of risk. Your standard deviation now is all out of whack because now your down capture, your risk exposure is a lot greater than what it would have been if you were more diverse in your portfolio and your investing. So let's talk about risk tolerance since I brought that topic up. Beautiful couple here. Ability of an investment plan to absorb loss. What is your risk tolerance? Personal risk tolerance. What is your personal tolerance for risk? Some people are more aggressive, some are more conservative. And you've got to know that. I tend to find that people are more conservative than they let on. I've worked with hundreds of individuals, many families, and I find that some people say, okay, well, I want to be moderate growth or balanced, and I want growth. And then as soon as there's a hiccup in the market, if the Dow is down sharply, they're on the phone, they're concerned, oh my gosh. And so you have to really know yourself. And it's my job as an investment advisor to really sort of help you understand who you are as an investor. I know that most people are not as aggressive as they say they are. And a lot of folks really cannot weather the storm emotionally. And so, but I know that after 25 years in this industry, you have to know your personal tolerance for risk. Are you aggressive? Are you moderate? Are you conservative? Let's put that in perspective. Think of a portfolio where you have 80% bonds, 20% equity exposure. That's more of a conservative portfolio. A portfolio where you have 60% bonds, 40% equity exposure is going to be more moderate. And a portfolio where you have 20% bonds, 80% equity exposure is more aggressive. When you chart that on a path, a chart that we call standard deviation, here's potential returns, what you earn, here's risk, what you could lose. The most conservative position here is treasury bills, and then certificates of deposit, and then government bonds, and then corporate bonds, and preferred stock, common stock, and then options and futures. But notice that options and futures also provides the greatest return potential, but the risk could be a lot more than you could bear to stomach. If a company goes bankrupt and you own it, the last people to receive payment are common stock holders. The first are the bond holders, the debt holders, and then the preferred stock holders. Preferred stock pays a dividend. Corporate bonds pays a yield. Common stock, preferred stock pays a yield also in dividends usually, but common stock may or may not pay a dividend. Okay, so on the spectrum of risk, treasury bills, CDs, government bonds, corporates, preferred common, and options and futures. Investment fundamentals, the relationship between risk and return. You want to balance growth, income with stability. when I think about building a portfolio, I wanted to accomplish a few things. I wanted to accomplish growth, but I also wanted to provide income, and I want that stability in the portfolio. One of the beautiful things about owning real estate is that if you own rental property, you get growth and you get income, and you have the stability because you own that property. The value could fluctuate, but if there's a tenant in that property, you're going to still receive current income. So it makes you a little less concerned about the fluctuation because the income is still coming in. And then, of course, there are tax benefits. And you want to have some of that reflected in your investment portfolio, your 401k, your IRA, your non-taxable or your taxable portfolio. So some investment options, type of options, cash alternatives, bonds, stocks, other investments such as real estate, alternative investments, commodities, funds, i.e. mutual funds, and lastly, 401k plans and IRAs are not investments. Just understand that. They are tax advantage vehicles that hold individual investments. Most people's wealth is in their home and in their retirement plans. So you have to manage this very, very carefully. You want to understand what you're investing in inside your 401k. If you're not really certain, give us a call. We will help you select the suitable investment allocation for you based on the choices that you're given in your 401k plan. So let's go back. I missed a slide here. Investment options, cash alternatives. These are the various types of cash alternatives starting at the very bottom here. One that's low risk and short term and very liquid or relatively liquid. Examples include certificates of deposit, money market deposit accounts, money market mutual funds, and U.S. Treasury bills or T-bills. And then you go up the spectrum. You have the advantages is predictable earnings because we know what CDs are going to yield. They advertise it on the windows of the bank, so you know if you're going to get a 1.5% return and for how long. Highly liquid, little risk to principal. The only risk to principal primarily in like a cash alternative is that it may not keep up with inflation. Okay, purchasing power. Disadvantages are relatively low returns, and I just said it, may not keep up with inflation. Investment options, bonds. There are various types of bonds. Many people think that you cannot lose money in bonds. Let me tell you something. You could lose your shirt in bonds, okay? And bonds can be more aggressive than an individual stock. So you've got to be careful. You have to understand the type of bonds there are and what impacts the value of your bond. Bonds are a loan to a government or a corporation. Interest typically is paid at regular intervals, and it can be traded like other securities. The value of a bond does fluctuate. Types of bonds are U.S. government securities, agency or GSE bonds. For example, Fannie Mae, Freddie Mac. Municipal bonds. These are bonds offered by your local community. For example, state bonds, right? So if you live in, Georgia or California or New York or North Carolina, you can buy muni bonds. They are tax deferred and tax free. And then there are corporate bonds, bonds issued by corporations. Some of the bond options advantages are they provide steady and predictable stream of income. So when you buy a bond, the beautiful thing is, unlike a stock, you know what your income is going to be in that bond before you buy it. In a stock, you hope that you're going to make money in that position, by buying that equity. So bonds, you have an idea of what your income is going to be, and you could purchase bonds. You can allocate them, diversify your bond portfolio or your bond holdings, and you could stagger them out over time like a ladder, like a stair step, so that you can have current income on a recurring basis. And depending on how well you manage it, you might be able to replace old bonds with new bonds with a higher yield, so your income grows potentially. And you can do that for many years. We built bond ladders here in WealthCare Financial Group for our clients. So there are steady and predictable streams of income. Income typically income is typically higher than cash alternatives. and relatively lower risk compared to options such as stocks. Of course, a bond is going to be a lot less risky and in relation to some stocks. But again, the health of a company determines the risk, the inherent risk of a bond. Think about a person with a lot of debt. They're going to pay a higher interest rate when they go buy a car, if they get a mortgage, or if they get credit cards. A person with much better credit pays a lower interest rate. The same is true of a bond. If the corporation is not in the strongest position financially, if they have more debt, then the bond yield is going to be higher. So the bond holder, the investor, is going to earn more income. If the corporation is in great financial shape, a lot of cash on the balance sheet, then the company can afford to get away with paying the bondholder a lower yield. Very similar to how an individual with great credit can demand a lower interest rate on their car note or on their mortgage. There's a low correlation to stock market. So general rule of thumb is when the market drops, bond values increase. To some degree, not true across the board in every situation, but there's some inverse correlation in the volatility and performance of bonds relative to stocks. The disadvantages is there's a risk of default. So you've got to know the credit quality of the issuer, the corporation, or the municipality that you're investing in. There are what's called junk bonds, and they're junk for a reason, but not all junk is created the same, and it's true. You have junk bonds from very stable corporations, and you've got junk bonds from some companies that probably are teetering on the brink of bankruptcy. So you've got to be careful and understand the overall quality and condition and financial health of a corporation before you invest in their bond. The value of bonds will fluctuate with interest rates, absolutely. Lower risk means lower potential returns than stocks in many cases. So let's discuss individual equities or stocks on the spectrum of risk and return. A share of stock represents an ownership position in a business. And the percentage of ownership determines your share of profit or loss. Earnings may be distributed as dividends. So a healthy corporation like Apple, which now pays a dividend, which is a great thing. Strong corporation, a lot of cash, healthy company. They are now sharing those earnings with the stockholders in the form of dividends, and that's a great thing. Shares of stock can be sold, of course, for gain or loss. Now, with respect to stocks, you really have two types. You have common and you have preferred. The preferred shares of a corporation stock will trade usually at a higher price per share than the common shares of a corporation stock. And then the category of stocks are small cap, mid cap, large cap. What does that mean? Simply put, corporations come in sizes. We reference that as capitalization. So a small cap is typically about $2 billion in total size of the company. The way you arrive at the cap is you take the price per share, multiply it by the number of shares outstanding. So the price per share of the stock times the number of shares outstanding, that answer gives you the total capitalization of that company, total size. And small cap is about $2 billion. And this is just sort of rule of thumb. I think it's changed somewhat now because of how fast corporations are growing with the internet. But typically, small cap's about $2 billion, mid cap's about $5 billion, large cap's $10 billion plus. Now, before the internet, it took a company a couple decades to get to a $20 billion valuation or capitalization. It took some time to grow that large because they didn't have the ability to do business at the speed of light through the internet. Now you have a company like Facebook. In their first 10 years, my goodness, they exceed $20 billion in total valuation before they're even publicly traded. So companies today can reach a capitalization in a fraction of the time it took bellwether companies, before the internet, like General Electric, General Motors, large corporations. So I think when we talk about large caps being 10 billion plus, yeah, that's true. But when companies are getting a $10 billion valuation in their first 5 years, is not, the same sort of scenario as corporations that we knew growing up and sort of relied on for many, many years. Disney being one other example. Now, stock terminology: growth, value, income, blue chip, and American Depository Receipt, ADR. Growth stock, think of it as, I use a real estate analogy. Think of a growth stock as you're walking down the block of a really, really beautiful neighborhood where the homes are all in the $1 million price range, and you pick out the most expensive house on the most expensive block, and it's for sale. And you buy that house. You may say, why would you do that? And maybe you pay a premium for that as well. And you do that because because you've done your research, that maybe in a year or two, that home value is going to spike and appreciate even more. So you have growth expectations for that home. A value stock is like buying the worst house on the best block. And who doesn't want that deal if you're a real estate investor? There is inherent value in that home. So you've got to do some work to bring up the value. A value stock, the board of directors, the leadership of that corporation, they have some work to do to realize the hidden value in that corporation. An income stock could be growth or value. It just basically pays a dividend. Blue chip stock, well, we're talking about the Dow 30. Look at the Dow Jones Industrial Average, the so-called 30 largest, supposedly most profitable bellwether, if you will, companies that comprise the Dow, like Exxon, Apple, I think is one now, perhaps General Electric for many, many years. And then American Depository Receipts is basically corporations that are trading overseas, and they're trading on the exchange, and you could, invest in those stocks. They're called ADRs. So those are some various types of stocks that come in various sizes: large, mid cap, and small cap. Some of the advantages is historically stocks have provided the highest long-term total returns, which is true. And you have the right to own the stock, of course, and it can provide income through dividends as well as capital appreciation. And it's easy to buy and sell. There's some liquidity. There's a market for it. You go to Wall Street, to New York Stock Exchange, and you see those guys on the floor running around in little jackets, colorful jackets, and they're yelling back and forth. They're creating a market. There's an exchange to buy and sell the shares that you own. The disadvantages are poor company performance affects dividends and value of shares. And not just poor company performance, but also bad behavior. We've seen that in the most recent recession. So you can have malfeasance negatively impact the value of your dividends and or shares. Subject to market volatility. Hey, you have rumors that come out. There's a saying on Wall Street: buy on the rumor, sell on the news. And the idea is you're going to buy low and sell high. It doesn't always work that way, but rumors can be true or false. It creates greed and fear, the emotions on Wall Street, and it produces volatility. In addition to that volatility, the economic cycle, recession, trough, recovery, expansion, peak, that also creates volatility that impacts the stocks that you may own in your portfolio. There's a greater risk to your principal. Yes, there is. I always tell investors that are sort of trying to figure out how to put their foot in the waters, if you will, test the waters of the market. I have a saying, it's so much easier to go from conservative to aggressive, meaning if you've got cash, you can just choose whatever you want to do. You don't have to hurry up and do anything. You can just hurry up and wait. If you've got cash, it's easy to start from conservative and migrate to aggressive. It's hard to go back because if you bought a stock at, let's say, $50 a share, and you take $100,000 and just dump it in there, and the stock drops to $30 a share, now you're down $20 and you've got to wait to get back to that conservative position to where you can liquidate and have your $100,000 back. It takes time. But if you are patient, you can buy a little bit at 50. If it drops, buy a little bit more at 30. If it goes up, you've made a profit on the second purchase, maybe broke even on the first purchase. So I think patience is a virtue when it comes to investing. And investing in stocks may not be appropriate for the short term. You've got to understand that time in the market, again, time in the market is often much better than timing the market. If you're going to time the market, you better have done a lot of research, have read a lot of books, and we have a pretty expansive library here at WealthCare Financial Group to help you understand how to become an astute investor or trader. We don't necessarily day trade. I do sometimes for myself, but really we want to encourage time in the market. Now, some other investment options: real estate, stock options, futures and commodities, and collectibles. I can talk to you about a few of these. Years ago in another life, I used to be a realtor. I think when I graduated from Howard University, met my wife, she was a realtor, and initially I was her assistant because I wanted to learn real estate. Then I got my real estate license. Then I later went into commercial real estate, and I was a commercial real estate broker in Washington, D.C., and I was a tenant rep leasing broker where we basically leased or tried to lease large high-rise commercial property to law firms, nonprofits, so forth. I later went and received and completed a master's program, a master's degree at Georgetown University. My master's is commercial real estate finance. And my interest at the time, and to some degree today still, was real estate private equity. And so some other investment alternatives, I think after you've laid the foundation in your portfolio, like in mutual funds, exchange traded funds, cash, bonds, etc., could be and probably should be real estate. Another thing you want to understand is stock options. Now, please do not put the cart before the horse. I receive calls from a lot of people that say, hey, you know what, I saw this advertisement on television, or I went to hear some hotshot speak at my church, or saw this program, heard some program on the radio about investing in options, and I want to start trading options. Look, let me just make myself very clear, because I've traded options. You could lose more than your shirt in trading options. You could lose your shirt and your pants. If you do not know what you are doing, trading options can be one of the most riskiest, foolish investments you ever make if you're not a student of options, okay? Understand that options is not like buying a stock. An option is a contract. An option trades both on the New York Stock Exchange, not as much as it used to, but it trades on the Chicago Board Options Exchange. So take a company like Apple Computer, which trades in New York, on NYSE or NASDAQ, one of the two. That company's option will trade on the Chicago Board Options Exchange. So if Apple is trading at like $100, the option contract, every contract controls 100 shares of the underlying equity or the stock. So you can trade the contract without buying the stock. The contract represents the right but not the obligation to own the stock. So if the contract is quoted at, let's say, let me give you another example. Here's a real life example in my case. So you all know about Martha Stewart. She did some insider trading, unfortunately. Slap on her wrist, she went to jail. I have a rule. My rule is don't risk emergency money. I had just come back from a cruise with my wife, a 10-year anniversary, 2004. and I was a branch manager at Raymond James Financial Services. And I did not have an options agreement on my brokerage account, meaning the right to trade options, because you have to fill out an application, submit it, get approval, etc. It takes typically about 3 days, but as a branch manager, since I was licensed as a branch manager, I could push it through in 1 hour. But I've got to make about 5 or 6, 7 phone calls and literally go up the food chain almost to the CEO to get instant, immediate approval to convert my account to an options account. And I just didn't feel like doing it. I wanted to do it, but I'm like, oh gosh, I got to sit on the phone for an hour. It's cold. And, I'm like, I'll just kind of. So Martha Stewart was about to be sentenced, and we're watching it on CNBC. And I said to my wife, I said, well, Lita, you know what? If she gets a slap on the wrist, the stock's going to go up from like $8 to like $12. If she gets a book thrown at her, it's going to drop from about $8 to like $4. I knew Martha Stewart, the woman, was not the stock. She's the figurehead. Martha Stewart was not the stock. It was a lot different than, let's say, Steve Jobs being the major influencer behind Apple. Okay, so what happened? I had $19,000. My rule is, and still is, don't risk emergency money. And the option on Martha Stewart stock was at 5 cents. 5 cents. So you got to multiply 5 cents times 100. And the answer is $5. Okay. So I was contemplating investing that emergency money of $19,000 in Martha Stewart options when it was at 5 cents or $5 per contract. I don't like to break rules, especially in investing, because you don't break your investment rules. My wife was like, well, maybe you should do it. I said, I probably should. I know even if she gets a book thrown at her, the stock's going to bounce back in about 5 months. But if she gets a slap on the wrist, and it's Martha Stewart, everyone loves Martha Stewart, man, this stock's going to fly. But I'm like, I don't feel like changing the brokerage account and don't want to violate my own rule. So that $19,000 could have purchased 3,800 contracts of Martha Stewart stock options, okay? The options on Martha Stewart stock. Now, 2 months later, the stock goes to about $36 per share. So the option contract goes to about $38 per contract. So now again, to get the price, you've got to multiply 38 times 100. The answer is 3,800. So I could have purchased about 3,800 contracts at a price of $5, and the stock later appreciated, and the contracts were about $36 per contract, or $3,600. So my $5 investment would have appreciated to $3,600 in 2 months. That $19,000 investment would have grown to $13,680,000 in 2 months. 2 months. Hence the power of options. Now, what if I took $19,000 and bought the stock when it was at $8? Okay, so I would have picked up 2,375 shares. And when the stock went to $38, it would be worth $90,250. So on one hand, I could have bought the stock, not the contracts on the options, not the option contract, but the stock, and made $90,250. Or I could have bought the contracts at $5 per contract, 3,800 contracts at $5, 19,000 divided by 5, 3,800, and watch it appreciate from $5 to $3,600 per contract, because the option contract went to $36. Again, every contract controls 100 shares of the underlying stock, so $3,600, and made $13 million in 2 months. That is the potential for options. But I also could have lost everything as well. And options are timed as well, because there's an expiration date. The closer you get to your expiration date, If the stock doesn't move, then guess what? It loses value. So you could lose 100% of your money in a stock option, because if you buy the option contract at $5 and you think it's basically buying a call, if you think it's going to basically appreciate to, like, I don't know, $15, and you have 6 months for it to get there in your call, there may be an expiration date of June 1st. Okay, and so now it's April and the stock's at $6. Well, your option contract is worth a lot less money. But if it's 2 months in and you're already at $13, you're probably doing pretty good. Again, the expiration date is set, and so you could sell the contract and keep the appreciation without ever buying the stock. You have to understand how that works, though. There's a lot of study that should go into options. I have a series. Not anymore. I let it go because I'm a registered investment advisor and no longer working for a brokerage firm. But from 2000 and I want to say 2 until 2016, I had a Series 9 and 10 license. It's an options contract. An options license, an options principal. So I was a branch manager with that, and somewhat of an options expert, but I don't do a lot of options trading. It's time consuming. There's a lot to it. So don't just jump into options because you heard somebody say you can make a lot of money in options. You can lose your shirt in options, or you can make a ton, but you've got to really know and be a student. Futures and commodities. Again, just like options, people are talking about trading Forex and all that stuff. And, there's options in Forex and futures and commodities. If you don't understand this stuff, stay away from it. Do the research, do the reading, spend the time, buy the books, call us if you need some recommendations on books, and become a student of this, because the money you lose will be the tuition that you should have paid by studying and becoming astute. The money you save by making money after you study is great, right? But you could lose money and then go back and do the work and say, well, I should have just done the work. I would have saved the money. So understand that. Collectibles, all right? I collect bass guitars. I'm a bass guitarist. My dad was. I like vintage instruments. Some people like cars. Some like jewelry and art. I've got a nice comic book collection. Yeah, but it's not really worth a lot. But then that is another investment for some. All right, so I spent a lot on the options, so I'm going to fly through this a little bit faster. Mutual funds. Many of you know what mutual funds are. Many of you already own mutual funds. Your money is pooled with that of other investors. Funds invest dollars according to stated investment strategy, and you own a portion of the securities held by the fund. Instant diversification. That's it. Mutual fund. It's an investment firm. There's a research analyst, there are traders, and there's a portfolio manager who directs the investments of the fund, and the research guys give that person the recommendations of what stocks to buy, and they basically charge a fee called an expense ratio that comes out of the total fund, and hopefully their fund makes money. One of the most famous mutual fund investors, Peter Lynch, one of my favorite, and also a guy named Michael Price. And I have to say this also, John Rogers. Let me give a shout out to John Rogers, who I've met many times at the Wall Street conference in New York, sponsored by Rainbow Push. Got to give a shout out to John Rogers. Okay, so investment options, mutual funds. Before investing, investors should carefully consider the fund's investment objective, risk, charges, and expense ratio. When we buy funds for our clients, when we look at their portfolios, we have a software that does some tremendous amount and some amazing investment analysis. It helps us peel back layers of the onion that most clients, investors do not see. And we're able to really show you what you really own. And that's important. It's really insightful. We are going to peel back the onion. We're going to look at who's managing the portfolio, where they went to school, how long they've been managing the money, how much money is in the fund, what the fees and expenses are. If there's what's called style drift, if they're staying true to their asset class, or if they don't have a specified asset class. We want to understand all of that because it definitely affects your portfolio. It affects your hard-earned dollars. It affects your rate of return and what you're paying. And we're going to do the research for you. It's complimentary, by the way. So on a spectrum of risk, here we are. Okay, you've got money market funds, bond funds, balance funds, stock funds. If you're not a stock picker, then maybe you should buy or invest in mutual funds or exchange traded funds. And there's international funds. Active versus passive. Okay, here we go. Active versus passive is as contentious on Wall Street as Democrats versus Republicans. It is true. There are two camps of investment professionals. The active guys and gals are those that say, look, I'm going to personally add alpha, meaning value added returns to the portfolio. I'm doing the research. I'm boots on the ground. I'm knee deep in this stuff, and I'm determining what stocks to buy. I'm going to add value and beat my relative index to that fund. Passive is like John Bogle, the late John Bogle of CEO of Vanguard Funds, who believes that we'll just buy the index. The index outperforms most funds, and most fund managers don't beat their index. You probably heard that before. That's not always true. I know that because I've got the software that can demonstrate the comparison between funds and indices. Funds sometimes beat their index, sometimes they don't. You got to think about what your purpose in that fund is, though. Whether or not you need index-like returns or whether you need balance, lower risk, or lower expense ratio. When you build a model portfolio, some things in the model are going to outperform the index. Some things probably won't, and that's okay. It's okay that everything doesn't outperform the index because maybe you don't need to be as aggressive as the index. You want to be diversified and have inverse correlation to the index. Some of your investments will outperform, some won't. That's okay. You can live with that. So some advantages of mutual funds are they are diversified. You receive professional management. They require small amounts of investments, many of them, and they're liquid. Disadvantages are value of shares could fluctuate daily, which they do. Portion of fund dollars may be tied up in cash for liquidity needs and potential for tax inefficiency, and mutual fund fees and expenses. So let me explain the disadvantages. So the value of shares, they do fluctuate. A mutual fund trades at 9:30 until the market opens at 9:30 in the morning Eastern time and closes at 4 p.m. The individual stocks in that fund, they trade intraday during 9:30 and 4, but the price of the fund doesn't change until about maybe 6 o'clock in the evening. So if the market is tanking and if it's going down and you've got $100,000 in the fund, you can't just say, oh, cut my losses and sell at 11 o'clock a.m. because I know it's going to get worse by 4 o'clock p.m. No, you're going to go down with the ship. You're going to be able to sell after that closing price sets at 4 p.m. and now you're going to get a lower price at 6 p.m. or whenever the share price of the fund changes for that day. An exchange traded fund is diversified like a mutual fund, but it trades like a stock. So you're able to cut your losses midstream in the middle of the day if you want, okay? A portion of your dollars may be tied up in cash for liquidity needs. Well, there are some funds that are closed-end funds, there are open-end funds, and there are some funds that are not as liquid as other funds, meaning you don't get your money back until the fund manager declares a liquidity event. Many of those types of funds invest in private real estate transactions. I stay away from those because I don't like people's money tied up where they can't get it back. It doesn't mean those things are bad, but again, suitability is important because a lot of financial advisors sold these illiquid REITs because they paid huge commissions, like 6, 7, 8%. And the investor wasn't really aware that their money's tied up for 2 and 3 years. And the fund advisors or the fund managers or the board of directors for the fund will say, okay, well, we're going to open up a window to let investors get their money back, but it's a window, maybe 2 or 3 months. And then that window's closed, so you're locked in again. I don't like those type of investments. It's illiquid. If you have an emergency, you need your money, I want you to have your money, okay? There's potential for tax inefficiency. There's what's called embedded capital gains. The portfolio manager of the funds are not going to pay your taxes. Their job is to make you money, to reduce losses, hopefully. And they're going to pass those capital gains on to you, the shareholder, and you're going to pay taxes. And then there's mutual fund fees and expenses. There's expense ratio. I wouldn't necessarily judge a fund good or bad by how much it costs. I think there's a measure when the cost is reasonable or when it's exorbitant, but price is always an issue in the absence of value, isn't it? There's a fund that I bought for my clients that had an expense ratio of like 1.5%. That's pretty expensive these days. But that fund had some phenomenal returns for many years. It had several years at 100%, had other years at an average of 60 to 80%. So I said, okay, we're going to add that fund to the portfolio. I think it'll do well, and it has, despite the fact that it has a high expense ratio. It's the most expensive fund in our model. But I did the research and said, okay, well, 1.5% is high, but these returns are phenomenal. And it met our filter before I even bought it. So I said, okay, well, it met the filter that we have, a very strict filter that we put together to buy or sell what goes into our model. It met those parameters. And then I saw the performance later. So, not bad. So it really depends. You got to do your research there. Exchange traded funds I mentioned. Most ETFs are based on an index. They're theme specific and index specific. You have ETFs, exchange traded funds, that follow the S&P, the Dow, the NASDAQ, the real estate index. They are sector specific. They could follow energy, technology. They could follow consumer durables, consumer distribution, and healthcare. They have various tracks which they follow, and they tend to invest in stocks that purely represent that particular sector or industry as an index. Passive management, so they're not active. Doesn't mean that they're bad. Active, again, they're not trading every single day. Okay, there may be 200-300 stocks in a mutual fund that's traded on a daily basis. Passive in an ETF means that they buy it and they hold it. And once a year, they'll kick some out and put some in. A mutual fund has what's called a turnover ratio. And that means how many times in a year does the fund sell everything in the portfolio and replace it? So a turnover ratio of 70 means that it holds 70% of what's in the it sells 70% of what's in the portfolio. A turnover ratio of 30 means that it sells 30% and holds 70. A turnover ratio of 100 means that they sell 100% and they replace it. An exchange traded fund doesn't have the same turnover ratio as a mutual fund. It's passive. It's not sort of traded daily. They buy, they hold, and once a year they'll determine who gets kicked out and who gets let into the fund. As simple as that. Can be traded throughout the day, bought on margin, and also shorted like stocks. So unlike a mutual fund, you can short an ETF. That gets into options trading and so forth. That's that mentality where you say, well, it's trading at 50. I think it's worth $23. I'm going to short it. So I think there's inherent value in selling it here and it dropping, and I collect the difference all the way down from 50 to 23. And guess what? I don't have to buy it to short it. You can do a naked short. It's an option strategy. Very risky. You got to know what you're doing, because you can end up owing money all the way down to, actually, if you think it's going to drop and it goes up, you can have losses all the way up to infinity is the idea. So unless you put a protective stop, you can keep losing money until the stock stops increasing. So, but you can do that with an ETF, and I don't recommend anything naked with respect to investing, especially option trading, that is. But you can buy them a margin as well. I don't use margin to buy because most of our clients are retired, or we're working with those who want to retire, and we're keeping them out of debt, and we're diversifying them properly. So we're not taking those types of risks, but you should be aware of the options and the options that you have and the opportunities you have with various types of investment vehicles. And they do provide some tax efficiencies because there's not the embedded capital gains from the trading as frequently as there is in mutual funds. There may be some, but not as much. Before investing, again, this is a disclaimer, consider the risks and so forth, charges, expenses, and that can be found in the prospectus for the available fund, which you should read very carefully before investing. Let's talk about dollar cost averaging. I use this method still. It is a tremendous method. You invest the same dollar amount at regular intervals over time. You buy more shares when prices are low, fewer shares when prices are high, and average cost of shares will be lower than average market price per share during your investment time period. What does it look like? So let's say you bought a share, XYZ stock. Here's 5 hypothetical investments. You bought 10 shares at about 33. Then you bought 30 shares, about 6. Then you bought 15 shares at 20, and then 20 shares at 15, and 12 shares at 25. So your entire investment was 30, 10, 20, 15, 25. Divided by 5, your average price per share is $20. Your average the investor's average cost per share, here it is, $1,500 invested. If you just add up the prices per share times the shares, $1,500 invested divided by 87 shares bought, your average cost is $17.24. The average price again was 20, but your average cost was $17.24 because you bought at different intervals, same dollar amount, but once a month. And we do this when we transfer portfolios from a competitor to Wealthcare Financial Group, unless the client says just invest everything day one. And sometimes they say that. What we'll tend to do is transfer the portfolio. We build an investment model, diversified model, and we'll put it in cash and money market. And once a month, over 6 months or 12 months, we'll move 1/6 or 1/12 of the portfolio from cash into the market. So we have this effect. And that smooths out the volatility. Guess what? If you bought here, you want your next purchase to be here. Well, you lost money here, but then you buy 3 times as much here. So you're basically going to average out your cost, and your average cost tends to be a little less in this example when you have a volatile market. And although our market has grown, it's been volatile still. Asset allocation considerations: diversification, risk tolerance, time frames, personal financial situation, and liquidity needs. So let's talk about sample allocation model. A conservative allocation model will tend to focus on preserving principal, 50% diversified bonds. Remember our bond scenario where you had government, agencies, corporate, etc., CDs, and municipal. 50% diversified bonds, 25% cash alternatives, and 25% diversified stocks. Not a bad model, because guess what? If the market drops, you've got 25% here to maybe go buy some more stocks over here to increase the value of your portfolio. There are some things you could do. And if you have an astute investment advisor who's including options trading in your portfolio, which don't always recommend you do, but some people do, well, you might anticipate a market drop over here and use an options contract to make money on that stock even though it drops, and then use some cash to buy some shares of that stock after it reaches what you may consider to be a bottom, and hopefully make money on the way back up. So that's more astute, it's more hands-on, it's an aggressive approach to some degree, but it's something that can be done in a portfolio. A moderate approach is asset allocation model. It tends to balance predictable income with potential growth. So here we have 40% versus 50% in bonds, 10% cash alternatives, and 50% diversified stocks. And aggressive. An aggressive asset allocation model will tend to focus primarily on potential growth. 75% diversified stocks. This could also be stock mutual funds and exchange traded funds. 15% bonds, 10% cash. Earlier in the presentation, I gave you 3 examples of conservative, moderate, and growth, where I said conservative is like 80-20, 80% bonds, 20% equities. Moderate, 60% bonds, 40% equities, and growth, 80% equities and 20% bonds. So there's some similarities in what we see in these examples here to what I shared earlier. Everyone kind of has a different rule of thumb. I may be a little more conservative than most because we're about protecting people's money. All right. So the role of a financial professional. That's me. Well, so yeah, I have a few. I've earned a few certifications, and you always have to be learning in this industry. I have a Chartered Retirement Planning Counselor designation. What is a CRPC? Well, you may have heard of a CFP, a Certified Financial Planner. The body of knowledge or the curriculum for the CFP and the CRPC is identical. The difference is the CRPC has more modules on retirement. The CFP is a little more in depth in each of the subjects. The CRPC gives you a lot of information about the subjects, but they go more in depth in retirement than the CFP does. The CFP may go very much more in depth in taxes. The CRPC may go maybe half the way in taxes. So it really depends on what you're looking for. Since we are a retirement firm, I thought that it would be best to receive the Chartered Retirement Planning Counselor designation. I've earned a certification from the University of Pennsylvania, the Wharton School of Business, and that is an advanced retirement planning, advanced retirement certification, and very exciting, very fun, tons of work. One of my dreams was to attend the Wharton School, so I did for a little while and earned a certification and sat with some of the best minds in finance. And we went really in depth in finance and also retirement. I also have I am a accredited investment fiduciary. That's one course, and completed an accredited investment fiduciary analyst. That's another course. So I'm a fiduciary. Every financial advisor or insurance agent has fiduciary responsibility. The question is whether or not they'll raise their hand and say, hey, I'm it. Okay, the brokerage industry does not want their advisors to be titled or tagged as a fiduciary. Meaning if you go to court and you have an issue with your advisor, maybe they lost money, God forbid, but if that happens, the burden of proof is on you to prove that advisor is a fiduciary, have fiduciary responsibility. They're not going to say, hey, I'm it. Well, I'm a registered investment advisor and I have a designation as a fiduciary. I'm saying I am it. I'm a fiduciary. I have the certification up there on the wall behind me. So, CRPC, Chartered Retirement Planning Counselor, retirement planning consultant, and accredited investment fiduciary and accredited investment fiduciary analyst. Our job is to manage people's wealth and help them achieve their retirement goals. To do asset allocation, we provide comprehensive financial plans in our practice, and we build model portfolios. We assist with estate planning, and we work with a team of professionals, attorneys, CPAs. We also own an insurance firm here at WealthCare Financial Group, so we assist with those needs also. I want to thank you for taking the time to watch and just be a part of this webinar on investment basics. I told you it wasn't going to be too basic. It was some basics in there, but I threw some things in there about options and other aspects of investing that I think people should be aware of for those for whom it is suitable. So again, thank you very, very much. If you have any questions, reach out to us. The landing page that you saw before this one, it provides more information, more pathways to help you achieve your retirement goals. You can contact us at 770-683-3608. If you're in the Georgia area, if you're in the Maryland, D.C., Virginia area, 240-482-3752. My email is msmith@WCFin, F-I-N, group, msmith@WCFingroup.com. Thank you so much again and have a wonderful day. Take care.